Yeah, we're in
on this page here?
module 1, but financial situation analysis 2. Document. Mhm.
Financial situation analysis.
Yeah, section 2.
Where it starts key ratio analysis. Which on my print is page 5.
Found it?
Yeah,
On
this is
possible.
on page, but you have to flip through that first one.
There's the first section.
Next stop. It's just the next page. Is that it?
Okay.
Okay, what we're going to focus on this morning is to looking at a very important area of how a business is performing, and we'll try and get through 2 case studies that we've done before, so it should be good revision for you. One is the clothing importer case study, which I hope you remember, and then the other one is the James the Grocer case. So there are 2 contrasting cases in terms of business performance, because if you remember the clothing import case, all of the sales were expanding and these profit margins were deteriorating. So we'll revisit that one. And then we'll look at the grocery store where the performance was better, and then we'll extract the cash flows on both. So it's quite an ambitious plan. Okay. So what we're going to start with is a ratio refresher. So you remember we did certain key ratios, and you've got the handout with the ratio calculations in. So what we tried to develop, if you remember, is a template that will fit any business with the exception of a financial institution. Financial institution accounts are very different. But this template we're going to put on here, we could use it on basic computers, we could use it on the Atlantis Town, we could use it on the store in Bay Street, or we could use it on the cases that we're going to do. So see if you can remember. Income statement, sales minus, what comes next? Yeah, cost of goods sold, very good. Or cost of sales, yeah. And that gives us what? No, that's further down. That gives us the gross
Gross
profit.
profit, okay.
Now this is very important because, yeah, the gross profit gives us the contribution towards the other costs in the business, including the finance costs, which come further down, yeah? So this gross profit margin is very, very important. So one of the key ratios we look at, which you'll see on page 5, the opening ratio is looking at sales to see if sales are growing or static or declining. And the second ratio is this important ratio of the gross profit margin. Now you calculate it as gross profit divided by sales times 100, that gives it as a percentage. What I like to do with smaller businesses is to assist us in conversation with the clients. If we talk in terms of, say, $100 sales, and if we work the gross profit and say it came out at 40%, it means out of every $100 of sales, they're generating $40 towards those other costs down here. So another word for it is contribution margin. So the contribution from the sales would be $40 out of every 100. Is that a good margin or not?
It depends on.
Yeah, it depends on the business, exactly. Very good answer. If it's a clothing importer, so he's importing goods and then selling them on to stores, the margin will be lower because he's not getting the added value. But in the store down Bay Street, the margin should be higher, because they've got the clothes, they bought them in here, and then they're marking them up. And if you went into the jewellery store, you know yourselves, the jewellery store markups generally are higher still, aren't they? So whatever accounts we're looking at, we'd have an expectation of what type of margin we would get. And we can also compare these margins with different different businesses, and then we can build up a data profile. Excel spreadsheet's a good idea. You build up a database that will help your experience, as a financial planner going forward. You can get ideas of what the margins are. And then if I visit a store that's similar to ones I've visited before, I have an expectation of the margin. So, okay, remember, I didn't ask you to memorize too many things, but one of the things, I asked you to remember, was the formula for cost of sales. Do you remember what the formula is? Let me start you off. It's opening stock plus opening stock plus purchases minus closing stock, right? You need to remember that. So write that down on your sheet. It's very important. Because when you're looking at business performance, what you have to remember is the auditor, the accountant, does not value the stock. The stock's valued by the business person, whether it's a small, medium or large business.
Was that open stock minus?
No, opening stock plus purchases minus closing stock. Now you won't need to make that calculation because the accountant will make the calculation, or the business person, but it's important to know what the components are of the cost of sales. Okay, so ratio number 1 on page 5 was the sales growth, which we get by taking sales in year 2 minus sales in year 1, and then divided by sales in year 1 multiplied by 100, and that will give us the growth percentage. Okay? Okay, Vince.
Minus closing stock.
So you found your workings from before? That's good. Okay, let's do the final year on clothing imports, just so we can make sure we're clear on the ratios. So you've got your ratio spreadsheet. So let's do year 3 on the clothing imports case. So try and work with the person next to you. Can you work with me now? Yeah.
Yeah, this should be,
You're on your own.
they keep scrolling now.
Now on page 13.
So what you need to do is keep an eye on the ratio calculations pages, how they're calculated. So with it being loose leaf, you could take that out of your binder, and then you want the clothing imports case, and you do something like this. So if we're doing year 3, we're looking for the sales growth in year 3. So what we've got is from page 13?
Page 12, eh?
12 and 13, that's what you want. If we're looking for sales, it's on page 13 on my print. Yeah? Okay, so sales growth. So what we've got is 1300 for sales in year 3. Put that in your calculator or your phone. Minus sales in year 2, 1050. Divided by sales in year 2, 1050, times 100, and you should get the answer. What do you get? It's about 20%, 24%?
1.3 million.
Yeah, so 1.3 million. So if you put in the calculator 1300, then minus 1050, and that will give you the difference.
3.8.
3.8. 23.8, okay. So what we're offered is 24%. 23.8.
Good morning.
Hello. Do you want
Yeah, Robin, sorry. It is an actual cash flow sheet.
That's module one. Yeah.
Everybody got 23.8?
Sam, you got 3?
Come on, we need to be sure on these figures because it's important that you can do this. You know. So you're sitting with a client, you know, you're going to need to know where these figures come from. So we're trying to look at business performance.
This one will be different.
Yeah, this is the here.
Yes, sir.
It's 12 and 13.
So if you're working together, one person get the ratios out and the other person have the case study, try and help each other.
Yeah.
Do you want to sit with this lady down here?
Well, we,
Or you're okay on your own? Or are you working with Miguel?
yeah, we will go.
Miguel's got 2 ladies.
Yeah, I can do it. I can punch in the numbers.
Come on, we've got to get moving because we've
Yes.
only got till
What are you
12 o'clock. Sales in year 3 minus sales in year 2
Uh-huh.
divided by sales in year 2 times 100, you should get 23.8%. So that's a very important start because most clients that you will meet, you know, as a financial planner, if they know no figures whatsoever, every business person I've ever met knows what their sales are. Yeah? That's why I like to start with the sales. So they're growing. If they're growing by how much? How does that compare with the previous year? Well, we did that before and you've probably still got the answer there. But we're not going to check, you know, like all the year's figures. But it's more than the previous year. Okay, the next one, look, very important ratio, as we said. So sales minus the cost of sales. Hello, sales minus cost of sales gives you the gross profit. Very, very important figure because there's lots of other costs going to follow on which we're going to categorize as overheads. So the next section would be the overheads. So we say minus the overheads. Some people call these the fixed costs. Some people call them SG&A, selling, general and administration. That's generally US terminology. And if you take overheads away from the gross profit, you get the figure, the term that you gave us earlier. Operating profit, very good. Operating profit. So let's take it a step at a time. So the next ratio number 2, is gross profit divided by sales. So let's do that together. Just for year 3 again. So page 13, gross profit 91,000. So 91,000 divided by 1.3 million times 100, you get the gross profit percentage. What did you get? 7% were offered. So GP 7%. So you can see every $100 of sales of these clothes, he's only generating $7 towards the remaining costs. So that looks very small, doesn't it? So it's a small margin, isn't it? It only generates $7 out of every 100 at the gross profit level. It's not net profit. This is gross. Yeah. So you know his performance is quite weak in year 3. So if we're sitting in a meeting with him, we'd want to ask him why. Now lots of clients you'll meet, they won't even know how to do this figure. Yeah? So if you say it's only $7 out of 100, he's probably quite surprised. So you can discuss in the more performance with him. Okay, let's see what comes next. So what we've got is ratio number 3, which is operating profit. And you'll see all these first ratios we do, they all go back to sales, right? Mm-hmm. All these stepping points down the income statement all refer back to sales. That's how the ratios are calculated. A bit later we'll do some balance sheet ratios, so they're all based on the balance sheet. And then a bit later from that we then do ratios that's a mixture where we're taking some figures from the balance sheet and some figures from the income statement. Okay. Next one then is operating profit. Again, divided by sales. Now here's something else you need to remember. Operating profit is profit before interest and tax. Or if you're sitting with an American client, what would you say with an American client? Is it PBIT? No, it's not. Generally they're called EBIT. Earnings before interest and tax. Yeah? Same thing, EBIT. And a bit later we'll start looking at cash flows. The opening point of the cash flow is EBIT. Yeah? It's EBIT. Yeah. Okay, so let's do that. So take your figure, operating profit, 13,000 from page 13, divided by sales, 1300. You don't need the calculator this time. How much? 1%. Yeah, be careful. Yeah, be careful with the zeros. It's 1%. So here's the bad news for this client. You know, in the client meeting that we're having, you know, every $100 of sales is generating $1. And of course, we haven't come to the bit here, which includes the interest cost and any taxation. Yeah? So there's more figures to come, and he's only got $1 to meet his finance costs. So the trading performance is very poor. Okay? Right, what's the next one?
Pre-tax.
Yeah, the next one is pre-tax, profit before tax. I've just lost it. Miguel, I'm sorry I've lost it.
Oh, scroll, so.
It's coming.
Yeah, just.
I'll change the rules here, so we won't go to the numbers.
Page 6. Everyday. Pre-tax.
So that's the 2,000.
Sorry, we got it good then?
Yeah.
We should. Section.
So we've done operating profit, and now we're doing net profit before tax. So net profit before tax is $2,000 here from page 13. Divided by sales of 1300. What'd you get for this figure? 0.15.
Yeah.
0.15. This format that we're developing here will fit any accounts, right? Except the financial institution. You know, this will fit the Atlantis Hotel, John Bull Stores, any type of business that you're going to be looking at. You can summarize it in this way. You could look on the internet, look at Walmart, download their annual report of the accounts, 200 pages, and then just head for the income statement and then try and practice with this type of format. So profit before tax, so what comes next? Well, if it's profit before tax, what's going to come next? Tax. So next deduction would be tax. And that will give us the profit after tax, which generally is the net profit, except in very large corporations there might be a dividend being paid out of this figure here. So you need to have a note of this, right? Because this will stand you in good stead for the rest of your business life, yeah? Unless the world totally changes. Because this is the format that you can use. It's the template you can use. Any business, right? And yours, Miguel. Sales minus cost of sales, gross profit minus the overheads to give you the operating profit minus the interest cost to give you profit before tax minus tax to give you profit after tax, which in most cases is the net profit. Now the one that's missing off our chart here is the bottom line position, the net profit. Yeah? So the final one we want to work is net profit divided by sales. So let's come right down to the bottom position. Look for his net profit on page 13. It's $2,000. It's the same as the profit before tax, yeah? So there was no tax paid that year. So net profit is $2,000 divided by 1300. So we're going to get 0.15 again. Yeah. Okay. So his bottom line, which Miguel's always interested in, I'm always interested in the top line. You've probably heard us say this before. It do get a bit boring because we say the same things. Yeah? The bottom line position is that good or bad?
0.15%.
Yeah. Well, it's dreadful, isn't it?
Yeah.
So he's making less than $1 net profit on $100 of sales. Yeah, 15 cents exactly. So the conversation with the client is, look, we know you're working really hard because to sell $1.3 million of clothing, there's no mean achievement, is it? You know, it's difficult to do in a competitive world, but you realise out of every $100 sales, you're only making 15 cents. Yeah? You happy with that or not? Any questions on that? So any questions on that so far? You need to be really firm on this because this is your understanding of the income statement. And as I say, you could look at Walmart if you want. Just pick a favourite business of yours. Just pick a favourite that you want to look at. Go on the internet, download from Investor or Media Relations. You'll see they're all free. These generally a PDF. Download it and just have a bit of practice. Don't be frightened with it. You should be able to put these in here. Even if they're billions, it doesn't make any difference. And try and quantify the performance of Walmart or whoever you want to do. All right with that? Okay. So if we're meeting clothing imports director as a certified financial planner when you pass your exams, yeah, or before, you know, there's plenty of scope for discussion with them, isn't there? You know, you don't know why, and he might not know why. So this is what's got to be explored. Why is the business so poor when he's got $1.3 million of sales? So what would be the starting point of the discussion? Where would we focus on to start with, do you think?
We'll start with good news.
With what?
The good news.
Yeah, which is what?
His sales is increasing by 23%.
Yeah, exactly, very good. Yeah, so you don't want to blow them over as soon as you meet them. You have to start with something. And I mean, that is good news. Sales have grown by 24% approximately in a very competitive market. But, Mr. Clothing, something's gone wrong with your costs, yeah? Because do you not realise, we're not accountants, we're not pretending to be accountants, but on the figures we've been calculating, you're making less than $1 out of every 100. So there's something wrong with the cost structure. So, back to page 13. When you're doing this sort of thing, you need to focus on what's the key costs. What's the key costs in here? What's the big costs? Yeah, exactly. It's not the SG&A, is it, or the overheads, because it's $78,000. So you're looking for the big cost. There's the big cost, look.
93% of the sales.
Yeah, 93% of sales is the cost of sales. Right, so back to our formula. What does cost of sales consist of? Opening stock plus purchases minus closing stock. So again, we'll be looking for the key figure. So where would we find those figures? Well, we find those in the balance sheet. So let's have a look at this balance sheet. Which is on the previous page. So there's his stock. Look, it's gone up from $190,000 to $257,000. So that's increased quite significantly. But the figure we're looking at isn't as significant as the remaining figure. What's the remaining figure? that we're looking at from the formula. See, we've done this, but then we have to work with it. Yeah? It's our analysis. What's the main figure? If this is 1.2 million, and we've looked at stock in stock, what's the other figure? It's purchases, yeah. So there's something must have gone wrong with his purchasing policy if he's only getting $7 gross profit. Everybody see that? So that's not too difficult, is it? I hope not anyway. So we need an understanding. So what we're looking at is how is the business performing, yeah? Now there is a clue on the first page of the case study. So if we look at page 11, there is a clue as to what's happening with these purchases. So the following extracts from the accounts, blah blah blah. He's a merchant engaged in some import and subsequent wholesale of ready-made fashion clothing from the Far East. So if he's buying from China, that would be one thing, but what does it say? Together with the majority of purchases, we're on page 11. Together with the majority of purchases being made from where?
London.
Yeah, so the question would be, do you think London would be more expensive or Far East? Well, London, yes. So he's changed his buying pattern, yeah? So that could be the reason why the margin is so low. So, you know, this would be a discussion with him on the source of the goods. Okay. So that's where we're up to so far. Oh, that's done it again. Next section is balance sheet. So we need a template for the balance sheet. We've done this before. We did it with a personal balance sheet. What is a balance sheet, remember? Statement of... Come on, you should know this now. A statement of assets and liabilities, yeah? So if I ask you to construct your own personal balance sheet, you'd make a list of the assets, the things that you own. You make a list of the liabilities, the things that you owe. And then if you take the liabilities away from your assets, you owe, you've got a personal net worth, yes? A lot of people in the UK at the moment, they haven't. They've got a negative net worth. Why? Because their main asset is the property in which they live, and property values have gone down. But of course the loan to the bank hasn't gone down as quick as the value of the property. So we don't want a negative net worth, we want a positive one. So it's the same when we look at the business balance sheet. We're looking at the assets and liabilities. So here's a template for the balance sheet. So on the left we can put liabilities, and on the right we can put the assets. And we can start with the assets. We start with current assets. Remember what they are? Cash, debtors or receivables, stock or inventory. So we get those current assets there. Then we list the fixed assets, which are things like property, plant and equipment, motor vehicles, stuff like that. And then we're going to get a figure down here for the total assets. Again, this will work on any business except a financial institution. So once again, you could be looking at a small business, you could look at John Bull, you could look at Acer Computers, you could look at the Atlantis Hotel. So we just simply list the assets, and then on the other side we list the current liabilities. And the first section are the liabilities that are due in less than 12 months. That's how the accountants define them. And that could be things like bank overdraft, supplier credit, yeah, trade creditors, maybe some short-term tax. Then you look at the longer-term liabilities, like loans. Then you add those together, so that's all the liabilities there. Take those away from the total, which we extend over here. And that will give you the net worth position, yeah? And again, that will work on small, medium, very large business. Do the same on Walmart if you want. Look at the balance sheet. you see the complication nowadays is the accountants present the balance sheet in a vertical format. And if you don't understand it, just go back to this template. This is how balance sheets used to be. When I first went into banking, they were really easy to understand because they were just like that. But they've become more complicated, like everything in life becomes more complicated, doesn't it, in terms of accounting. I mean, it was called a balance sheet because it balanced. You try balancing a modern one, it goes that way, doesn't it? It's very difficult to balance it. And this is what we're looking for, the net worth. Is the net worth of the business improving or deteriorating? So what we use now is some ratios from the balance sheet. They come next. So let's have a look at the next one. Okay, so the first one is the traditional calculation of working capital, which is the current assets minus the current liabilities. So from the balance sheet on page 12. So this one's presented vertically, so it's a little bit more difficult to understand. Where's the current assets? Year 3, $487,000.
Yeah.
See that? Minus the current liabilities, $435,000. And the accountant's done it for us, and they're calling that net current assets, the 52,000. So the first calculation is 52,000. Right, got that? Ratio number 2 is where we take the same two figures, but we put one over the other, and that's known as the current ratio. The reason for that was traditionally, if we work this ratio, we're looking for the current assets to be able to exceed the current liabilities. Yeah? So if the business stopped trading, the idea would be the current assets recovery would extinguish the current liabilities. Some businesses you look at, you'll see current assets are less than the current liabilities, and they're still managing satisfactorily. The next one is what's known as the quick ratio, but we just work the mathematics first, sorry. So current assets were 487,000 in the calculator, and divided by current liabilities 435, so it's going to be 1 point something to 1.
1.12.
1.1 to 1, okay. Now the quick ratio is where we're looking at assets that turn over more quickly, so we deduct the stock. As generally stock is the slowest moving asset. So this time it's current assets minus the stock or the inventory. So you take your 487 for current assets, then deduct the stock of 257, and then divide that by current liabilities of 435. And what do you get this time? 0 point something?
0.5.
0.5? Now these three ratios are of importance, but they're not as significant as the next ratios that we're going to go on to, because the next ratios have much more impact on the cash flow. Now, as a financial planner, these next three ratios, ratios 4, 5 and 6, are very, very, very important because they have a dramatic impact on the cash flow. Lots of business people don't understand that. So what you've got is ratio number 4 is the credit that you're giving to your customers. This is your debtors or your receivables outstanding. A very, very important figure. Can you see that? So number 4, put a circle around it or an asterisk, very, very important. And again, this is one of the figures that business people generally are aware of, but they don't really realize how much impact it has on the cash flow, because if your credit given is quite a high figure, until you collect it in, it's going to affect your cash flow. So when you collect it in, it will improve the cash flow. But before you do that, it has a negative effect. So let's see the first one. It's debtors divided by sales. So this time we're jumping between the balance sheet and the income statement. Okay? So debtors by sales, debtors from the balance sheet year 3, 230,000. Divided by sales, 1300. And then we multiply by 365 to get this into days. 65 days? Huh? Good or bad?
Five.
Yeah, it sounds quite a long time. It's over 2 months, isn't it? And generally, most businesses, if it's terms of trade, they give a month, 30 days. So it's 65 days to collect in these receivables. So again, that's good scope for discussion with him. The next one is very important. Ratio number 5 is the stock turnover in days. Now this time it's calculated from the balance sheet and the income statement again, so it's a mixture of the two documents. So we're looking for stock. So stock on page 12, 257,000. Yeah. Now we have to be careful here because we don't divide this by sales, but we divide it by cost of sales. So I'll pause at that moment in time because some analysts do it by dividing by sales, right? Some people do it by purchases. So there's no right and wrong answer, but the general accepted way of doing it is the way we're doing it, stock divided by cost of sales. And that's the one that's recognised by the chartered banker, we're setting your example. So let's get that figure. So stock from the balance sheet, 257,000 divided by cost of goods sold at 1209, multiplied by 365, 78 days. Okay. Good or bad?
Five.
Yes, it's bad, isn't it? It's a lot of, it's a lot of stock holding, isn't it? 78 days of stock of ready-made up fashion clothing, yeah? And of course styles change, so there's a question mark about your stock. Now, if we add these two together, what we've got is 143 days. Now why I do this is because both of these will need financing out of cash flow. So if you're not collecting in your debtors, you're using cash flow until you collect it in, because you're granting people credit, don't you? Your customers credit. The stock will need financing until the stock's sold and you get the cash in. So if you add that to that, you get those two items which are like gross financing needs out of working capital. That's a very big figure. But most businesses then get some relief from the next ratio, number 6, right? That's why these three are very, very important. This is where he gets relief by taking credit from his suppliers, yes? So the next one is trade creditors divided by cost of goods sold times 365. Anybody got the answer? We're doing, you need to keep on this list here. We're doing number 6. Trade creditors divided by cost of goods sold times 365. 85? Okay. So creditors, I'll put it in red, 85. So what's happening is his financing needs are debtors of 65 days, stock of 78, so his gross financing is 143 days, which is a very big figure, but then he's getting relief from his suppliers of 85 days. Yeah, but nevertheless he's got a shortfall of 58 days within this cycle. Now this cycle, most people call it the working capital cycle, okay, and that's what you read about in various textbooks. The more modern term is CCC, cash conversion cycle, which I quite like. Yeah? So this is the CCC, cash conversion cycle. Cash conversion cycle, some businesses have a very quick cash conversion cycle and some very slow. Can you give me an example, anybody? Quick one. Who would have a quick cash conversion cycle? It's a business that lots of you visit every day.
The liquor store.
Yeah, the liquor store. I was thinking the food store, but the liquor store would be faster still, yeah. Yeah, because you get to the checkout and you pay, don't you? You don't become a debtor to the liquor store, right?
Yeah, man, you have to.
Sometimes.
Sometimes you
Yeah.
do, if you can't pay, sometimes you might grant you credit.
You have the food store.
No, but generally it's a fast cost
Yeah,
conversion
food store.
cycle. Anyone think of the opposite, a very slow one? Furniture production, making furniture.
I would say it's retail in terms of payment plans to pay back or not really.
Yes, I mean it could be quite slow if they're generating payment plans. Yes, but I was thinking of another one which is more applicable here in Nassau. Well, construction projects. Yeah, if you think of a construction project, how slow the cash flow is going to be because it's negative until the thing's finished. Yeah. Think of the new Chinese hotel there. Oh, it's taking them to build. Yeah, but it's building quick. Yeah, but when it won't pay back till it opens, yeah? Yes, that's a slow cash flow, yeah? Manufacturing business. If you visit a manufacturer, say they're manufacturing clothes, they'll have raw materials, and they'll have wages in the factory, they'll have work in process in the factory, eventually make the finished garment. But generally the factory doesn't sell for cash. Generally they sell to other people who are going to sell the garments, yeah? So that would be a slow one. So as a financial planner, this is very important, yeah? So as a financial planner, this is your starting point with the income. Start with this, don't start with this. It's more difficult for people, yeah? Your cash flow is always more difficult. Start with this, discuss the income statement, and then you can move your way around the balance sheet a bit, looking at the structure of the balance sheet, and then start to look at some of these cash conversion cycles. Some people call these business metrics. So it's another word for you, business metrics. Okay, so those three are very important ratios. We'll go into the cash flow in a minute. And then we come to a ratio that's hardly ever used, which is ratio number 7, where I think it's a very, very important ratio. Hardly anybody ever uses this. You can look at lots and lots of bank spreadsheets for analysis, and hardly anybody ever uses it, but it's very important because it's the full test. Business is about working the assets. Now this is one of the ratios that's very, very important in banking, but hardly anybody looks at it. Because banking is all about managing the balance sheet, isn't it? And working the assets in the balance sheet. But this figure should be looked at. This is how efficient is the business at managing all of their assets. So what we do here is we take the sales figure, and it's an easy calculation. We simply divide sales by all of the assets in the balance sheet. So what we're saying is, here's all the assets in the balance sheet. Let's see how many times those assets are being turned over relative to sales. So it's a measurement of efficient use of assets. So sales divided by total assets. So sales 1300 divided by total assets. Now, no, that's current assets. You have to add on the fixed assets, remember, to get total assets. So we've got 487. Go down the page, the fixed assets. So 487 plus 53 gives you 540. So 540,000 of total assets. And then divide that figure into the sales of 1300. So what do we get for asset efficiency?
2.4.
2.4. Okay. So 2.4 times is turning over the total assets, yeah? Now is that good or is it bad? We can't really answer that. We need to look at what it was the previous year and what it was the year before, yeah? To see if it's deteriorating or improving.
So what's the benchmark?
There isn't a benchmark on that. But all it is a matter of common sense, yeah? So if this was a fish market, right, would 2.4 times be good or bad? Well, it's a tricky question. It would be terrible because you'd expect a much faster turnover with fresh fish in a fish market, yeah? You know, with different businesses it would be different. The best measurement on this is to look at how, you know, the past performance, to see if it's improving or deteriorating. Okay. Now the finance ratios are very important. The interest cover, the leverage and the gearing. So these are different. These are looking at the financial commitment of the business. So number one is the traditional ratio of interest cover. And Congress have used this for a long, long time, and it's looking straight into here. Look, so we're into our template again here. And what we're saying is there's the interest cost, there's the operating profit. What we're interested in is how many times is the interest covered. So we take this figure and divide it by the interest and we get a measurement of how many times it's covered. So operating profit year 3 was $13,000, yes? The interest cost is 11,000, so if we divide 13,000 divided by 11, you're going to get 1 point something times interest covered. So interest is still covered, but only just. Traditionally, we look for 2 to 3 times interest cover to give us a comfortable position. Are you okay on that one? We lost it. So operating profit divided by interest. Looking at this, you can see it's quite obvious where it comes from. Here's the profit before interest and tax, or the EBIT. Yeah. Then we're taking that figure, and the one that comes next is interest. So what we're interested in is how many times this covers this. So what's the lender's position? Is there comfort there? Well, in year 3, it's just over once covered. But if you look back to year 1, look at operating profit there, 33,000, interest cost 8. So you can see in the first year it's more than 4 times covered. So the lending position then was much more comfortable than it is now. Number 2 of the finance ratios is leverage. This is looking at a wider measurement, and I'm sorry the page is split, but it's total liabilities divided by the net worth. Going back to our template, on here look, the total liabilities, remember, were the current liabilities plus the long-term ones, and then you're going to divide that figure by the net worth. So let's try it ourselves on the balance sheet, year 3. So page 12. There's current liabilities, look, 435,000. Yes? Then we need to look further down to see if there's any long-term liabilities. Yes, there are. There's longer-term liabilities of 7,000. So total liabilities are 442 divided by the net worth, which is the shareholders' funds here, 98,000. And then multiply by 100 and it will give you a leverage percentage. So what do we get for leverage?
451.
451%?
4.5.
4.5?
I guess.
No, we need to do it as a percentage. So take
451.
all the liabilities divided by 98 and multiply by 100.
451.
451%, yeah. Now, why we do it as a percentage is because of the impact and discussion with the client. Do you think that's high or low? It's incredibly high, isn't it? I mean, 100% leverage would be a full figure. Here's this business with 451% leverage is leveraged right up here. So again, it's a danger signal. So what we've seen so far is falling profits, only 15 cents profit out of every $100 of sales. Then when we looked at his cash flow, we were worried about the cash conversion cycle. Now we're looking at his financial commitments. Look at the leverage, 451%. Okay, now the other ratio is the banker's favorite ratio worldwide, which is the gearing ratio. So let's look at that. Now the difference with gearing, and if you want to write on your sheet, this is also known as debt equity ratio. So some people don't call it gearing, some people say it's the debt to the equity ratio. But worldwide, it's generally known as gearing. Now the
multiply, or we have to multiply it by 100%.
You don't have to, you could put 4.5 to 1 if you want. But you see, if you're with the client, and I say to Miguel's the client, and I say, oh, your business is 4.5 to 1 leveraged, you know, does that have as much impact as if I say to Miguel, you're leveraged, 451% leveraged, yeah? So what we do, working in finance, is we try to use the measures and discuss the measures in a way that makes more sense with the client, yeah? Is that okay? Yeah. So some banks would just put 4.5 to 1.
Okay, to 1.
Yeah, same when we do this next one. Gearing, some banks would say it's so-and-so to 1, yeah? But I like a percentage, so let's do gearing as a percentage. So this time we're looking for the debt to the net worth. Leverage was all the liabilities to the net worth, which is this figure here, all the liabilities to net worth. Gearing is looking for the debt in these liabilities to net worth. Now what I wrote on the sheet to try and help you with this is total interest bearing, right? That's to give you help when you're analysing it. So let's do this together. So if you look at the balance sheet for year 3, so get ready, we'll go through this together. And what we're looking for is going through the liabilities, looking for the liabilities that would charge interest, and therefore we can classify those as debt for this calculation. So here we go, current liabilities. Supplier credit, would they charge interest, yes or no? Well, generally no, unless there's some sort of penalty clauses, yeah? So we don't put that in the calculation. Hire purchase, that's installment financing, they would charge interest, wouldn't they? Yeah? So take the 2,000. The bank overdraft, yeah, they definitely would charge interest. So we got 2, we got 138. Tax, they don't charge interest unless you're in penalty terms. Directors' loans, generally there's no interest attributed to that. So now we're going down to longer term liabilities, further down the page. There we are, long term installment financing. Yes, that would charge interest at 7,000. So for this gearing calculation, we've got 2 plus 138, that's 140, plus 7, so that's 147 this time, divided by the net worth again of 98. And you can do it as something to 1, or you can do it as a percentage. So what do we get for gearing?
1.5 to 1.
1.5 or 150%? Anybody confirm that?
Yes.
Yeah, great. Okay. Now I know that was very, very quick, but you need to be familiar with this. And you could do the same thing again on the James the Grocer case. Any questions on that? So let's think about it. Let's just recap on this bit before we do the cash flow. So what we started with was looking at the income statement. Good place to start. It's the place where most business people have a better understanding than the balance sheet, yeah? And most people like yourselves generally have a better understanding of the income statement. So try and start with something that you're comfortable with. Don't jump into something that's more uncomfortable. When I first went into banking, The banking textbooks of the time, and I can quote for one, the one that I got first, the guy who wrote the book was a very well respected banker in London, but he said the banker needs to have no regard for the trading of the business. All he needs to focus on is a balance sheet. I mean, that's absolute rubbish, isn't it? But it was highly regarded at the time that was the starting point. Yeah? Things have turned around now. Yeah? You've got to start with the income because this is driving the business performance. This is over 12 months, isn't it? What's this over? Yeah, it's at one point in time. Yeah, we can take it today. So then we move on to the balance sheet. We look at these key business metrics: the cash conversion cycle, debtor days or receivables outstanding, stock days or inventory, and payables or the supply creditors. And then the combination of those three will give us the cash conversion cycle. Very important thing to look at. When we do it for this business, 143 days he needs to finance receivables and inventory, and then he's taking supply credit of 85 days, but there's still a big shortfall of 58 days that's got to be financed from somewhere. Okay, so to see the impact of these, we now go on to the document that everybody loves right across the world. That's a joke, everybody hates this. It takes the cake off this week. That same experience. We had 2 accountants in the room, 2 certified, what were they? CFAs or
It was
whatever?
CPAs, Certified Public Accountants.
Remember when we got to this part? It was difficult, yeah? So it's not easy. It's not easy. You will never be expected to complete this worksheet. The reason that we do it is so that when you get the cash flow statement, we hope, from the customer, or we persuade the customer that it's very important, just like this case, because he's got falling profits, he's got a slow cash conversion cycle. We try to persuade him with help with the accountant to produce the worksheet or the cash flow statement, and then because we've done it ourselves, we should have a good understanding of where these figures are coming from.
I have a quick question back on to
Yeah.
the carrying.
Okay, that's good. I'll take the questions now because I'm going to have to rub this off to do the worksheet.
Is shareholders fund always able to determine tangible asset?
Well, that's why we do this way. The problem with this section here is in a small business it might be just called capital. In some businesses it can be called shareholders funds. In larger businesses, you can have share capital, revaluation reserve, all sorts of reserves and stuff like that. So sometimes, and then if you look at the bank, goodness me, if you look at the bank's net worth position, it's all sorts of complex instruments. So if you're not sure what the net worth is, just do what we did on there. So we'd have current assets of 487, look at that, plus the long-term assets of 53, so that gives us 540 over here in this box. So we take a box approach, yeah? Up here, current liabilities, what figure?
435.
Plus the longer-term liabilities. Now take that figure away from the total asset figure, and with a bit of luck you should get 98,000, I hope. You do? No. Yeah, so that's how you prove what the net worth is, yeah? In this case, net worth of the shareholders fund. So I'd always recommend you do that because it clarifies your mind on what you're looking at as the net worth of the business. Yeah? So if this was Walmart we're looking at, it doesn't really matter. We could look at Walmart's current assets, Walmart's fixed assets, add the two together to give us Walmart's total assets, then look at the liabilities, take one from the other, and you'll get the net worth, and then look at what they call it, yeah? It could be called shareholders funds.
So those two terms can be used to include the net tangible asset?
Yeah, you can.
Okay, just wanted to make sure.
That's the complication with these accounts. Okay, let's move to the cash flow. We're doing pretty good. What I'll do actually is I'll try and leave this on and I'll write the cash flow at the side here. So the cash flow using the cash flow worksheet, again, we're just going to do the worksheet.
Yeah.
Are you okay?
Yeah, just checking on the food.
I'll try and squeeze it
ถูกต้อง
in down here. Do you remember where we had the worksheet on this?
The cash flow
Yeah.
is in James Groshop, actually.
Right.
So,
Yeah, okay, yeah. But we've got that. And then we've got this here. We have to pick some figures from this. Okay, now what you've got in the case study of clothing imports, you've got some accountancy prepared figures here. So you could say, well, why do we need the worksheet? Well, you need the worksheet, in my opinion, because it's our third template that should help us with an understanding. Yeah? If you look at these figures, to me, they're a jumble, they're all over the place. I can't really understand what they're telling us. If we use the worksheet approach, we'll be able to extract it. Are you short of a worksheet? The lady at the back?
no, she'd be looking for the
For what?
statements of cash flow.
I found it.
Oh, you got it?
Yeah, it's in the case study. Have you got it?
You got it? Page 50, it's supposed to be page 15 post.
Yeah, it's just one page further on. So balance sheet's page 12. Income statement 13.
Uh-huh,
Summary ratio sheet was 14.
uh-huh.
And then the statement of cash flows page 15. You're going to need page 15,
Yeah.
page 13 and page 12 for this next exercise. So you have to help each other, make sure you've got all the documents. Okay, so the opening point on the cash flow worksheet, everybody look at the opening line. The opening line is profit before interest and tax. Or if you prefer, EBIT. Okay, it's the same thing, so you can write on your worksheet EBIT alongside PBIT. Whether we're looking at a small, medium or large business, it's the same entry point. The only complication you'll find is if you get an American presentation of cash flow, it will be different to the international one. The Americans will not move to international accounting standards at the moment. They say that's because their accounts are better than international, which I don't believe, because Enron was a US corporation, WorldCom was Tyco, Madoff was American based, etc., etc. So there's plenty of evidence, but you know what the Americans are like, you know, they stick to what they want to do, and the rest of the world we have to just do what we want to do. So it's two methods, but whatever method you're looking at, you can use the template to figure out the cash flow. Now what we're interested in on your cash flow worksheet is line D. So please put an asterisk against line D. Line D is the bottom line cash flow position. At that point, you need to be saying to yourself, is the customer that I'm working with cash positive or cash negative? Yeah? Or if you prefer the term at line D, are they a cash generator or a cash consumer? Lots of businesses you meet will be cash consumers. Some businesses will be cash generators. Now that's the true line for the cash flow. If you read accounting textbooks, quite a lot of accounting textbooks mislead you, confuse you. Moody's used to confuse you because they call the cash flow EBITDA. And if you're in discussion with an American banker or American accountant, you often hear them say EBITDA. Yeah, that's their jargon. Miguel's got another jargon, haven't you?
Ninja?
Ninja. Ninja is? He opened the conference in Turks and Caicos. by talking about ninjas. The man who was the equivalent to the governor in the North Central Bank, he thought he was talking about turtles or something. This is the main regulator, and there's Miguel welcoming everybody. It's a great introduction. You start talking about ninjas. Come on, Miguel, what's a ninja? It's
Well,
a
a
person-
ninja is an acronym for no income, no assets, no job.
No.
No income, no job, no assets.
Ninja.
That's what the
Because it was a credit seminar, so we're talking about making loans. And of course, the joke about the US is they had lots of ninjas, but the states still had the money, didn't they? Yeah, it's called subprime mortgages. So it was very, very smart. I couldn't remember what a ninja was. Well, it was being told him years ago what a ninja was. Okay, opening cash
No
flow.
income, no job.
no assets. Somewhere.
So it should be named NAS, but
That's what my social bank loan officer told me.
Huh?
My social bank loan officer told me.
You do what you want, Dad.
okay, opening point of cash flow then is EBIT or PBIT on the cash flow worksheet. Then we add back the non-cash items. Generally that's only depreciation because you never write a check out for depreciation, yeah? Although depreciation is charged against the income statement, so it's an accounting item, you know, nobody actually writes a check out for depreciation, so we can add it back as a non-cash item. There will be others occasionally, one of which is amortization. It doesn't feature in this case. So what we've got is PBIT adding back the depreciation to give us what we're calling at line A, the gross operating cash flow. So that's the entry point, yeah? The entry point of the cash flow is GOCF. So let's just do it in the final year for clothing imports. So take his final year profit on page 13, but you have to be careful here because what we're looking for is the profit before interest and tax. Everybody see that? 13,000? Yes?
Yeah.
So put that onto your worksheet, 13,000. Add back depreciation. Now this is where it gets a bit tricky and we have to refer into some of the figures the accountants provided us with. Here we go. Look. There's the depreciation from page, whatever, 13 is it? 14? 15? Page 15. It's page 15, depreciation $2,000. So we pick up the 2,000. So I've got a GOCF of $15,000, yes? Now that's where I stop for a second for two reasons. One is this is the opening point of the cash flow, and then there's lots of other items to follow. So $15,000 doesn't sound so much, does it, when you think there's lots of other items to follow, yeah? And we want to look at the previous year and the previous year, but with the time we've got, we're just looking at this 1 year. So let's see what comes next. Now the next section is probably the most tricky to extract, because the next section on the worksheet, can you see the word movement in? Yeah, so please underline movement or highlight movement. That's a key word. So we're not looking at the stock or inventory balance, we're looking at the movement in the balances, because the movement in the balances will affect the cash flow. So if we start with the movement in stock, where are we going to get that movement from? From the balance sheets, yeah? So let's look at the balance sheets on page 12. And what we're looking for is the movement in stock between year 2 and year 3. I can smell something.
Yeah, some syndrome.
Some activity. It's ninja again. 67,000 is the movement in stock. Now then,
How much?
well, it's gone from 190,000 to 257. Now it's at this point where we have to think about this. Now there are ways of memorizing like an increase in an asset is a use of cash flow, decrease in liability, blah blah blah. But I don't want you to do that because that would be terribly difficult to remember in an interview with the client. Yeah? So what you need to do is figure this out from your common sense, so it'll always be like available to you in your mind. So if we think about it, if stock is increased, so if this business person has increased the stock from 190,000 to 257, they've got more stock in the business. Would that use cash flow or generate cash flow? It'll use, yeah, because it's got to be financed. When they sell the stock, it'll generate cash flow. But meanwhile, they've used it. Now, under international accounting standards, when you're looking at cash or the use of cash, you put it in brackets. Right? When you generate cash, it's a positive figure. So if we've used cash of 67,000, the stock would be 67,000 in brackets, yeah? It's a use of cash. So that's your next figure for your worksheet. Next point is debtors, or the receivables. Same thing from the balance sheet, page 12. Debtors have gone from 170,000 to 230. So there's an increase in debtors of 60,000. So here's a question for Miguel. If more people owe you money to your business, is that a use of cash or a source?
As a source.
No, it's a source when you collect them in. But until you collect them in, if they've
Accounts
gone up,
receivables.
yeah, accounts receivables, it's a use of cash because you haven't collected them in yet. It's had to be financed. So 60,000, again, everybody okay with that? Goes in brackets. This is why you've got to figure this out and think about it, because if you're in a meeting with the customers, you know, you've got to have it clear in your mind, which will help you in the discussion. Next point on the worksheet is the trade creditors. So this is the suppliers to the business. So look at page 12, there's the creditors, 180,000, increase to 280,000. So supplier credit has gone up by 100,000. So the business person owes more money to the suppliers. Is that a source of cash or a use? It's a source, yeah, the source additional credit, just like sourcing credit from the bank. So that will generate cash flow. So 100,000 this time is a positive figure. Very good.
So can we say that once it is there's an increase on the asset side, we can use that as a negative?
You can if you wish to memorize it that way. I don't encourage that, because then if you're in discussion with a client, you're thinking, oh, is this increased asset or decreased liability or whatever, yeah? I prefer you to try and just think of the basic principle that if a business person has more people owing them money, yeah, when they collect that in, it'll be good for cash flow, but until they collect it in, it's bad for cash flow, yeah? So try and approach it from the cash flow impact position, and that will really help you. Just like we did here. We said debtors, 65 days. Yes, when they collect them in, that will be fine, but meanwhile they've got to be financed, yeah? So that's how you look at it. Okay, now there's nothing else in this particular example. There's no prepayments, no accruals, no sundry items. So line B, here's where I'd like you to write on the worksheet. Where we put change in working investment, you could put change in working capital, if you prefer. Or you could put change in the cash conversion cycle. That's a problem in business, you know, there's lots of terminology, yeah? So we put here change in working investment. So what is the change in working investment? What is line D? Line B rather. It's 127 negative, and then we've got 100,000 positive, so 27,000 negative is the summary of those three, yes? So what we do next is we look for the net operating cash flow, and you'll see on the worksheet I put A plus or minus B, because occasionally you'll find this section that we've done here occasionally generates cash, but generally it's a use of cash. Most businesses use cash.
Sorry, I did interrupt you. Can I get you guys just some curry chicken? Are you okay?
What time do the chicken sell?
Oh, sorry. That's fine?
That's fine.
Yeah. So
Sorry about that.
it's okay. No, generally it's a minus B, okay? Because generally you've got a negative figure here. Occasionally you get a positive. You get a positive summary. Just add that to this, yeah, to give you the NOCF. So in clothing imports case, the NOCF. So that was the gross operating cash flow, which was positive. His NOCF. This is the bad news. After financing his working capital cycle, look at what's happened. He's used more cash in his working capital cycle than he's got. So he's already negative. So when we were worried here, about these business metrics, we should be worried because when he translated it into money, he's negative. So he's negative 12,000. And there's things to come, isn't it? That he hasn't done yet. So what comes next?
Interest expenses.
Yeah, interest expense. Now this is where, when we looked before at interest cover, we looked at interest cover from the income statement, because the interest is charged in accountancy terms to the income statement. Now this is another complication in life, yeah? In life, you pay, or the business person pays, their interest out of cash flow, don't you? So the bank will want the interest charge whether the business is profitable or not. So interest is actually paid out of cash flow. So second measurement of cash flow, of interest cover rather, would be cash flow interest cover. So we don't throw the old one away, but we think about this new one as well. So let's look at the interest cost. So next item on our worksheet is interest expense in year 3 from page 13, $11,000 in brackets or positive? Brackets, of course, because interest has to be paid. So 11,000. So you can see the problem that he's got. He's got no cash here to pay his interest cost, which means he's got to get cash from somewhere to pay the bank's interest cost. He might have to borrow money from the bank to pay the bank their interest cost. So his cash flow is in a real mess, yeah? It's in a mess. So let's see what comes next. Dividend, there's no dividend on this case. And there's no debt repayment cycle schedule that we know about, so we're going to leave that item on this case. So line C, the net cash flow after servicing debt, will be net cash flow after debt would be 12,000 negative, 11,000 negative, 23,000 negative. And then there's fixed asset expenditure or disposals and taxation to come next. There's only 2 more items to come, okay? Now the next bit is where it gets complicated because of the accounting presentation. So I always have to say to people, you need to trust me here, because when we get to the bottom of the cash flow, we've got to balance it. The thing with cash is you can balance it, because cash is a fact, yeah? When you look at an income statement, there are certain items in here that could be manipulated or adjusted. So profit can be, not exactly right. Balance sheet, items in here that are valued, so that could be a bit incorrect. But when you come to cash flow, when we get to the end, we've got to balance it against the source document. So why I'm saying this is because of the complexity we're just going to look at in a second. So if we look here, purchase or sale of fixed assets, $7,000. If it's a purchase of fixed assets, will that use cash flow? Yes, and why hasn't the accountant got it in brackets? So you have to be careful with some of these figures. Similarly, if we move further down, look, the figures we had for debtors in stock, we had them in brackets, didn't we? On this presentation, they're not. So there's something gone a bit skewy with the accountant's figures. So we have to stick by our logic and see if we balance the cash flow. So if you don't mind, we'll put the fixed asset expenditure, $7,000 in brackets, yeah? The next one, taxation. If you pay tax, that uses cash, of course. So where's the tax figure? Here it is, look. Tax paid, $5,000. Why is that not in brackets? Yeah. It should be in brackets, shouldn't it? You know, if you pay tax, it's a cash outflow. So let's stick by our principles and put the 5,000 in brackets. So what I've got for those two items is 12,000 negative, yeah? Plus the 23 negative gives me 35,000 negative. And that's the line we'll be looking for, the net cash flow, line D. Okay? So, cash consumer or cash generator?
Consumer.
They're consumer, and we've quantified it. He's consumed cash to the extent of $35,000. Now when you get to this line, there are only three things you can balance this line with. If the business is short, they've got to take cash from cash reserves, debt from debt providers, or equity or new capital coming into the business. There's only those three to prop up the business if it's negative. Yeah? If the business generates cash, there's still only those three. They could pay down some debt, they could put some cash into reserves, or they could return some capital. If you don't believe me, look at any large business, again like Walmart or whatever, and you'll see it's only ever those three. So let's see what's happened with clothing imports. So you can see on the worksheet I've left the cash right till the end, and I've put an asterisk there. Reconcile with source documents. This is what I meant about proving the cash flow. So we'll leave the cash. Increase in equity. Anybody brought any new capital into the business? No. There's no more share capital introduced. So that's a line. What about debt? That's what we need to look at. Let's look at the debt position from page 12. Bank, that's the short-term debt. Yes, there we are. Look, it's increased from 105 to 138. So there's a change in debt of 33,000. Is that positive cash flow or negative? It's positive because he sourced additional credit. So we've got 33,000 in short-term debt. And then look at the long-term debt further down. There we are, look, long-term installment financing has gone from 5,000 to 7,000, so he saw some long-term debt as well of 2,000. So there are two positives which will balance out the net cash flow. So to balance the net cash flow, he's taken debt. So according to our calculation, there's no movement in cash. So we need to prove that by going back to source documents, which is this again, the balance sheet again, on page 12. Look at the cash on this business. Is there any? No, it's zero, yeah? So it's 0, 0, 0. So you can't prop up any negative cash flows here from movements in cash because he hasn't got any cash. This is the clothing imports case we just reworking this revision. Everybody okay with that? So he's borrowed. Now if we did this exercise on the previous year, we'd see that he borrowed more debt then. So he's got negative cash flows. The only way he's surviving is by taking more debt. Okay, so what will happen next year? Could be worse. If the debt provider would give him a loan, yeah, because don't forget, we've now got a very deteriorating position here, haven't we? Where he's hardly making any profit at all. And we've got leverage 451%, yeah? And we've got debt gearing 150%. So the question would be to you, if he came to you and you were a lender, would you lend him more money next year? Probably not on the performance we've seen. So you see, if in the next year, if the risk he's facing is if he continues in his business manner in the next year, similar to what we have seen, he'll go broke because he's got no cash reserves. If no one would lend him any more money, would you put money in this business if you were an investor? Would you take shares in this business based on what you've seen? Of course you wouldn't. So the business could go broke. Why? Because it's run out of cash flow. Everybody okay with that? Questions?
I guess an advising him, you have to kind of try to advise him on the plan to get out of that.
Very good, very good. So that's when you put your advisor's hat on. And where would we start?
Start with this process
Cost of sales, very good. And lease purchasing policy, yeah?
Yeah.
So what you have to say to yourself is, as a financial planner, if this customer came into you, is it a hopeless situation? Some people you deal with, they're no hope, isn't it? It's going to be just a mess. But what we can say is there anything we can see in this that could possibly help them? If we're going to try and develop a business plan, what could we do?
Well,
Don't buy from London, eh?
Yeah, that's one
That's
point.
one.
Get a sweatshop,
Back to China.
get a sweatshop.
we need to get rid of that inventory and get that
Very
sold.
good, that's another thing. So you've hit the nail on the head of
Yeah,
two
sale.
things. Good.
You need to
So-
declare and say it.
So let's look at that. So there's the closing stock and there's this buying policy, yeah?
Yeah.
Yeah, so that's two good things to discuss with them. What we could also, during that discussion, is say, well, let's go back and take a look at how you were performing before. Let's look together at page 13. So yes, over the 3 years we've been looking at, sales have increased, from $900,000 up to 1.3 million, which seems to be good news, but it's not because everything else has gone the other way. So if we went back to the first year, was the business in reasonable shape then?
Yeah.
Yeah, it was. Look at the profit they made. He made profit after paying the bank's interest charge of $8,000 and paying tax of $8,000. He had net profit of $17,000 on sales of $900,000. Look what's happened now. He's got profit $2,000 on sales of 1.3 million. So it's a nonsense, isn't it? The only place I visit is here when you say, what's the stupidity or what's his foolishness? That's a bit insane, isn't it? Yeah. What's his foolishness? That's what it is, isn't it? Why is he working his butt off to get $400,000 of extra sales when his profits have gone down from 17,000 to 2? So that's the starting point, yeah? So there could be some hope, but he's got to get rid of London in terms of purchasing, so that's one aspect. And then what's his other key requirement? Yeah, he needs, capital's not the right word, what does he need here? Yeah, what we're looking at is a business plan that would involve the generation of cash. So how can he generate cash?
Yeah, to sell the stock.
Yeah, sell the stock, yeah. So he's got a huge stock balance. Let's look at the stock in the balance sheet.
Yeah.
He's got $250,000 worth of stock on the balance sheet.
Forget it. So quicker, because of the days of turnover,
Good.
you gotta get the quicker. I see also here, okay, well, his administration cost has gone up significantly as well. But it's another line item there. In year 3 compared to year 1 and 2. So there's expenses.
So I'm running out of
The highest someone else.
I'm running out of space now.
Business plan.
So the business plan we're looking at, let's recap. We want to look at his buying, yeah?
Yeah.
You know, he's buying. And then we want to look at a way of generating some cash. He's got to generate some cash. And the way of generating cash would be to have a sale of this huge stock figure, yeah? Stock sold for $250,000, 257. So he needs to focus on some stock disposal, because if he sells stock and the stock figure reduces, well, this time it would be a cash inflow as opposed to outflow. Yeah? So from page 12, year 1 to year 2, the stock went up by 135,000 up to 190. So there was a use of cash flow of 55,000 between those years. Yeah. And then year 2, year 3, the stock increase of 67,000. So in both years, you know, he's used significant amounts of cash in the stock balance. So that's the sort of focus you would have, you know, as a financial planner in discussion with this person. But my recommendation would be you wouldn't do that just with the customer. You'd ask for the accountant to be present here. You know, get their inputs into it as well. Anything else to catch on this? Time for the food?
No, they could grab it and take it when they.
10 minutes for any more.
I mean, actually, to
questions.
run you all, but once we're done, I sort of need this.
Okay, so just to recap then. So just to recap on what we've been trying to do this morning, yeah? We've been trying to look at business performance as you would as a financial planner, yeah? And what we've been doing is looking at the business performance and then we translated it into a cash flow. So we did the various ratios which you missed on the ratio template. You know, we looked at sales, we looked at cost of sales, operating profit, all those things relative to the income statement. Then we moved into the balance sheet, and I recommended to you using this box method if you're not too sure where these things go. Current assets plus fixed assets to give you total assets. Carry that across. Take away the liabilities, will give you the net worth position. Then we looked at the 3 very, very, very important ratios that drive the cash flow. The collection of the debtors or receivables, 65 days, we thought was very high. The stock turnover, we thought was very slow at 78 days, bearing in mind the type of trade he's got, fashionable clothing. And then we looked at the payment of suppliers to give us a net position on the cash conversion cycle. And it's quite a negative position there of 58 days. Then to confirm our worries about the cash flow, we extracted a cash flow worksheet. Opening point of the cash flow is the EBITDA, you hear talked about a lot, or PBIT, adding back depreciation. So we have $15,000 coming in on the business, so it is positive, but it's not that much when you think of all the other items to come. Then his bad news was here. Stock increased 67,000, uses cash. Debtor outstanding, more people owing him money, 60,000, that uses cash. He got relief from his suppliers, 100,000. Would they do that again the following year? Again, probably no. You know, look at the credit balance. So within this cash conversion cycle, or within this working capital section, it's negative 27, and he's only got $15,000. So after financing his cash conversion cycle, he's negative at 12,000, and he hasn't paid the bank the interest cost yet. So the bad news is he's going to have to get some money from somewhere to pay the bank's interest cost. And when we progressed it further down, we found only way he could do this is by borrowing more debt, taking more debt. So actually what he's doing is borrowing from the bank to pay the bank's interest cost. So he's in quite a dreadful state. Tax, we know, is paid out of cash. And the bottom line cash flow position was negative 35,000. I don't think in the exam you will have to construct the cash flow.
No, so you
You have to interpret it. So you need to understand it. You don't need to do the mechanics of it.
Yeah, it's all multiple choice, but they'll give you, you'll have in a 50 questions case study, you'll have a case study somewhere like this with the cash flow, where you have to read and answer.
You know what it means, yes.
Interpret
So why would I give you all this pain?
Yeah.
Well, the reason is because, well, you weren't here, so you had no pain. You missed the pain, didn't you? You came in just at the right time. So why we did that is so you have a much better understanding where these come from.